It seems as though your team has been kind of predicting a pullback in the stock market for the last month or two. What else has you concerned, or what else had you concerned about the markets?
Yeah, sure. So, I think it's helpful to set the stage that, equities made all-time highs all summer. Up until September, we continued to grind higher, melt higher. We saw a large period of time go by where there wasn't even a 1% move in either direction from the S&P 500 and other global indices. And that was despite this weakening economic backdrop where, we had this bad news is good news regime take place once again, which implies that, economic data slowing is met with, optimism from the market or optimism from investors because they can rejoice in knowing that the global central banks will likely keep the easy money and the pace of accommodation the same. And so while stocks really shrugged off these downgrades to growth, we felt like it was only a matter of time before volatility picked up after the summer lull, especially ahead of a lot of this geopolitical uncertainty, which always concerns the market for a very short period of time before ultimately resuming higher. And so, again, despite the weaker data, also earnings continue to recover in a pretty spectacular fashion and are now expected to hit all-time highs this year. And that partly reflects, that some of the largest sectors within the market are technology and communication services. They make up about 40% of the S&P 500. These businesses, they saw very few negative impacts from the pandemic, and in a lot of cases saw stronger revenue growth as many Americans are sitting at home watching television and spending more time on their phones and social media. We saw revenue growth really accelerate. And again, these are some of the largest companies within the market. And so we've also seen, as I mentioned, consumer demand certainly bolster, earnings. We've also seen higher productivity levels from businesses as they've been able to reduce costs in a virtual environment. But ultimately, the markets are forward-looking. I think more forward-looking than maybe a lot of our clients or investors realize. And things might get harder for stocks despite a more favorable economic backdrop. Growth is slowing, wages are rising, interest rates are rising, demand is cooling, global supply chains are a mess, and we'll probably have a corporate tax increase. And so we felt like investors were being a bit complacent. And I think valuations, even despite the pullback, certainly look more attractive, and they have gotten more attractive because of earnings growth and because of the price decline. But it could be a bit of a speed limit as we go into the new year, just given where things are at.
And we were discussing this earlier this week that going back to 1950, the S&P 500 has experienced, on average, 3 separate 5% pullbacks every year, and averaged about a 10% correction about every year as well. So I guess you could say we're kind of overdue for one.
Yeah, we were overdue. Again, as you mentioned, 5% pullback. I think it was the longest we hadn't had a 5% pullback, or excuse me, 8th longest time that we hadn't had a 5% pullback going back to the 1930s. So despite seeing the market indices move higher for much of the summer, we started to see some signs underneath the surface of the market where breadth was weakening, despite, again, that index performance masking a lot of that chop. And again, valuations are looking a bit more attractive after the sell-off. After all, there's 2 ways for companies to look less expensive. It's prices move down, P and the E equation, or E moves higher, right? And we've had both really take place this year where earnings growth has been significant. And so, as I mentioned before, I think, valuations still are elevated to some degree. I think, it's helpful to look in terms of the market relative to, say, the bond market, for example. And if you were to compare, forward-looking earnings, forward-looking PE multiples of the S&P 500 compared to, say, the 10-year Treasury, are actually only around like 34 percentile type of evaluation. For going back, I can't remember the exact date that went back over, but certainly, in the early 1900s. And so my point is, valuations have looked a bit stretched in certain areas within the market, especially given some of this evolving economic data. But in context and relative to bonds, they actually don't nearly look as expensive. And so it's helpful to look at things. It's really all relative. And so, I guess going back to an earlier question, we expect the global economy to continue to grow above trend next year. We expect robust earnings growth to be an important catalyst for international markets as well. And so, one of the things that's really important is diversification. Just because the S&P 500 is selling off, or because maybe an investor thinks that the S&P 500 has an unattractive valuation doesn't necessarily mean there are not stocks underneath the surface or companies that compose that index that won't look attractive. And if you look outside the United States, both emerging markets and developed markets are at some of their cheapest levels that we've seen in the last 20 years. And so we've seen vaccination progress take place there. We've seen significant progress as far as, the economic activity picking up as a result of that vaccination rate, climbing higher, and a global post-pandemic economic rebound, lower trade tension probability, prospect of a lower dollar, which really helps many of those businesses. Ultimately creates a really compelling argument, I think, for international equities. And so, last thing I'll mention, we're headed into a very, very important earnings season. Third quarter earnings season will kick off next Monday in earnest. Ultimately, with 47% of the companies by market cap in the S&P reporting during the week of October 25th. And about 86% of companies will have reported by November 6th. So the next 3 weeks in particular are going to be extremely important. Consensus estimates for S&P 500 growth are expected to be up about 27% year over year, with quite a bit of a sharp deceleration from what we saw in the second quarter, which is 88% growth year over year. Again, comparing it to the bottom of the pandemic, in March and April and May of last year. But ultimately, this growth has come from both margin expansion, meaning companies are more profitable, but also from top line sales growth as well. And so, I think the last thing I want to mention is we've kind of had a fairly low bar for earnings season last quarter. We may have a fairly low bar for earnings season this quarter, and that could push the indices back to record highs by the end of the year. But it's going to be so critical to hear the commentary from leadership of these companies, how they're managing through a global economy still riddled by a pandemic. And I think corporate taxes are also presenting a risk as we head into year end. And while it's a moving target, it could impact S&P 500 earnings by about 5% next year through the proposed tax increases to corporations.